Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Cameron, welcome back to the Australian Finance Podcast.
Hi, Owen. Thanks for having me.
It's always good to chat with you, mate. It's the sun is shining here in Melbourne, which is a rarity, so I'm in good spirits. But if people can't tell, I'm a bit nasally. I did get a COVID test recently, so hopefully we can make it through and talk about some really interesting things. And one of the things that we're going to talk about today is currency hedging. And while this may seem like we're mixing a few different finance words together, it's actually really important. And I think it's really important that we have this conversation now. We are going to include a link in the podcast player for anyone who wants to dive deeper in this to your research, Cameron. Which is great because we're just talking about it off air. And I think for anyone that has an established portfolio, if you're in retirement, this is a really, really important topic. We've also got a bunch of questions that have been sent in, so we'll be answering those as well. To kick things off, I'd like to just break the ice. I like to start with a few short answer questions, if you will.
Always on. Looking forward to them. What have you got today?
So the first one is, if you could only invest in one asset class for the rest of your life, so just one, Australian shares, US shares, whatever the case may be, however you want to cut it up, what would it be and why?
Yeah, okay. I would have to say US equities. Personally, I'm a big believer in US exceptionalism. I think the US economy is the most dynamic in the world, as is their capital market. And they've got a very fluid labour market. They've got actually very flexible bankruptcy laws that allow entrepreneurial spirit. And as a result, you just see so much value created out of US companies. And so I'd say US equities for the long haul. That would be my one pick of an asset class, if you like.
Okay, no, that's fine, mate. You've chosen the US over Australia. I get it. That's fine. But no, seriously, it is a very good choice and a very fine one indeed, with so much riding behind the US system, whether it's technology, whether it's defense spending, democracy, all those types of things. Number two is, and this is bringing it back closer to home, if you could have dinner with any Australian investor, past or present,
right,
who would it be and what would you ask them?
Okay. Can I have dinner with myself 10 years ago and ask them about some of my stupid investment choices?
Sure.
Yeah, so I guess I'm probably not one of those who is a big fanboy of particular investors. I'm not, I don't, follow Warren Buffett's, annual newsletter or anything like that. I guess one Australian investor that I think would be very interesting as a dinner party guest would be Chris Joy. Joy from Coolabah Capital. He's a very, sort of widely published author across various publications, including the AFR and Livewire and the like. And he's very opinionated. You're never, unsure as to where Chris sits. He really does like to, cut through the noise. And I know Chris relatively well, and I think he's very entertaining actually as an individual. So he'd make a good dinner party guest. And so I'd probably have to say Chris Joy.
Yeah, that's fair enough. I was funny story, but I was actually many moons ago when I first met him and saw him present. It was actually over a lunch at the RACV club in Melbourne, and everyone just gravitated towards him. He was actually sitting at my table, and it's just like people just love him, love him or hate him.
He's polarizing, right? Yeah, polarizing guy, but yeah, very, very entertaining. And look, I mean, in all seriousness, he has a very deep understanding of the Australian banking and financial system, which I think is really important for understanding the Australian economy and markets.
Yeah, fair enough. Okay, final short answer is, what book, podcast, or resource has had the biggest influence on your investing journey?
Right. On my investing, so I mean, I think there's been some books that have certainly influenced my career. Things like Liar's Poker, Michael Lewis, When Genius Failed, which is Roger Lowenstein, about long-term capital management. In terms of investing, I think maybe on a previous podcast, for some reason, I've used the same answer here, but John Hull, the derivatives textbook, is one that I started studying derivatives, and that's really one that I think influenced some of my early investing decision making. Really looking for asymmetric payoffs, if you like. Similar to the Nassim Taleb sort of school of thought on if you like black swans and the ability to profit from non-normal distributions if you want to get into it. But they're some ones that really influence a lot of my investment thinking. And then beyond that, I listen to various podcasts at the moment. I listen to the NAB morning call most mornings, just on a daily basis. But there's also one from JP Morgan called Eye on Thoughts on the Market, Eye on the Market, by Michael Sembalest, who I think he's a really interesting commentator on markets. And I value his insights and his views on markets.
Yeah, I like that. The Hull textbook is like for people that don't go down a financial or investment career. Just so you know, this is like the kind of like the Bible for derivatives. And yeah, I remember when I was studying the CFA curriculum, Cameron, everyone was like, "Why don't we just read his book? Why are we reading this?" And it's so true. It's a heck of a book. So, mate, we're going to talk about derivatives right now, which is probably a bit of a foreign concept to some non-finance people. But one thing that is very familiar to everyone that listens or watches this show is this idea of global investing. You mentioned it there, US shares, US equities. Straight out of the gate, we know companies, Apple, Microsoft, Nvidia, Tesla, whatever. These are the companies that are shaping our world, at least from a consumer and technology perspective. ETFs, in my opinion, are the best way to get global exposure because you don't need to leave the Australian shores, so to speak, to get global investment exposure. But one of the decisions that is often not talked about is a really important decision, which is this idea that you either choose an ETF that is currency hedged or you go with one that's not currency hedged. Now, to make sure we don't leave anyone behind, I want to talk about, firstly, what is currency hedging, if you can define that, and then I've got a few follow-up questions that might lead out of that.
Yeah, great question. So what is currency hedging? In a simple sense, currency hedging is about when I'll talk about it from the sense as to the way most people would use currency hedging is a currency-hedged ETF or fund. So if you think about what currency hedging is trying to achieve, if I'm holding assets denominated in a foreign currency, I'm trying to use some form of strategy or overlay to ensure that the return I get as closely matches the performance of those assets in their home currency. So in other words, if I'm an Australian investor and I'm investing in US dollar denominated assets, I'm seeking a return profile which is akin to what a US investor would receive in those assets that's not influenced by changes in the value of the Australian dollar over my holding period. Now, there's various ways you can go about doing that, but it's really about seeking the return of those assets in their home currency.
So the good example of this would be, here we go, I've got Bloomberg right beside me on the screen. I'm that much of a finance nerd. And it's saying, market's up 0.8%. They're measuring that in US terms, US dollar terms, not the Australian dollars, which is where you and I are seated here today. So effectively saying we would get as close to as possible the return that someone watching this in the United States would get, for example.
Yeah, that's right. And I'm not sure what the Australian dollar's done this second, but if the Australian dollar had appreciated while that US market that you were looking at had appreciated, then you would get less than 0.8 of a gain in Australian dollar terms. And it's really about eliminating the movements in the Australian dollar. In particular, you're trying to eliminate the negative consequences of the Australian dollar appreciating, obviously. This is why you're looking to use currency hedging.
So I remember there was a period, I think it was, I could be mistaken here, Cameron, but I think it was in the lead up to 2010, 2011, where the Australian dollar did really well, as in like the Australian dollar, when people Googled it, it was going up and up and up and up, which was an issue for people that were investing in US shares. So is that the kind of concept of like we want to protect to make sure that if we do have a portfolio of US shares, for example, that are growing and going up in value, that the changes in that currency just don't eat away at that?
Yeah, I mean, that's exactly right. And you're right, there's been some periods of real strength in the Australian dollar versus the US, just to take that simple currency pair. And often I think a lot of investors suffer from recency bias. If we look at the Australian dollar, broadly speaking, over the last 14 years, it has been depreciating against the US dollar. And so if you've invested in US equities, as you know I love to, and you are doing so on an unhedged basis, you've had this twin tailwind of strong performance in global equities but also a falling Australian dollar. And so I think a lot of investors have become conditioned to think, well, this is probably the norm, or this is my expectation. But as you pointed out, there are periods of time where the Australian dollar for long periods has had quite a strong upward trend. You talked about that period. There was a period of very strong Australian dollar appreciation just post the GFC. There was also a really strong period of appreciation between about 2001 and 2009 or 2008, just before the GFC, where the Australian dollar went from 50 US cents to about 90 US cents. And to think about the resulting outcome over that time period, the S&P 500, the US index in US dollar terms, returned, I think it was around about 40% over that time period. If you're an Australian investor and you were holding that S&P 500, your return in Australian dollars, taking into account the fact the Australian dollar was appreciating, was actually about negative 17%.
Wow.
So you can see that depending on what our dollar is doing, currency can have a massive impact. It can be positive, it can be negative, but it's certainly worth thinking about when you're deciding what you're investing in terms of global assets.
I've got an example which I'll get to in a minute, which I think is really relevant, and it highlights one of the Betashares ETFs. But firstly, just to double click on the currency hedging, I think people that are interested in this, and this, I'm getting a lot of questions about this, is like, how is it actually done? If you can explain that, like in simple terms for someone that's like not a finance person, like how does it actually work? Like it sounds like it's too good to be true. Like you just kind of like, you peg the currency. Like how does that kind of work?
Yeah. Okay. So I'll use a simple example, throw some numbers in there to try and sort of illustrate the point. And, we can also obviously unpack anything here, but if we think about, firstly, let's think about an unhedged global equity fund. So let's say that this unhedged global equity funds holds $100 of US equities. And let's just say that currently the exchange rate is currently the Australian dollar sitting at around about 67 US cents, which would translate to an Australian dollar value of around about $150 Australian. Right. Mm-hmm. So let's take that investor and the perspective of the Australian investor in that portfolio. They've currently got a portfolio which is worth $150 Australian. Now let's say that over the following month, the US dollar assets don't change in value in terms of their US dollar share prices, but the Australian dollar appreciates such that now my $100 in US terms are now, rather than worth $150 in Australian terms, are now only worth $140 in Australian terms. Now I'm unhedged, and as a result, the value of my portfolio, despite the US dollar stock prices not changing, has fallen in Australian terms by about $10, right? So I'm worse off, and that's as a result of the Australian dollar appreciating. Now, the way that currency hedging works is you hold the exact same underlying assets, but at the start of the month, as well as holding those assets, you enter into a contract to sell US dollars in 1 month's time, and you are selling 100 US dollars, and you are aiming to receive 150 Australian dollars. Now, over the month, the Australian dollar value of the underlying shares has still fallen to $140 in Australian terms. But that contract that you've entered into will now have a profit. You'll be basically up $10 on that contract. You close out that contract. The value of the fund is now $140 in terms of shares, but $10 a profit. So you're back to your $150 square. You've eliminated the impacts of currency hedging. Now, I mean, this isn't, I guess, a free lunch. You could see the Australian dollar depreciate, in which case your currency hedge would have realised a loss that offsets the gain in the Australian dollar value of those US shares. So it can work both ways. But the important thing is, if I'm looking to eliminate movements in the Australian dollar versus US dollar from my overall return, I've done a pretty good job of doing so by entering into this currency hedge as well as holding those US equities. Does that answer the question?
Yeah, it does. So basically there's like a contract that goes on behind the scenes if I invest in, say, one of the Betashares currency hedge range, and that contract can have a profit or loss. And that's kind of what offsets the gains or the losses in the currency. That makes sense. So then another question I wanted to ask you then is, like, as soon as people start thinking about derivatives, they might have a flashback to the GFC or maybe like the Big Short movie, something like this. And a question that would come up is like, well, is it safe?
Yeah, absolutely. And you should always ask these sort of questions. So, you can also refer to the PDS for currency-hedged ETFs, and you can look through sort of risk disclaimers there, and encourage you to do so, do your due diligence. Look, currency hedging and the way I describe currency hedging of entering into 1 month forward contracts, they're actually called forward contracts, where you agree an exchange rate as to which you're going to exchange currency 1 month forward, are very standard. They are very widely used. At Betashares, we enter into these contracts with the world's largest and most highly accredited banks. So we use, for example, JP Morgan is one of the counterparties we use these contracts with, and your exposure to those banks is quite limited. It's basically limited to changes in the currency over a 1 month period, which tend to be relatively small in terms of the size of the overall fund. But importantly, you're doing it with very robust counterparties, and that's really critical. So what I would say is that currency hedging is very much a well-trodden path. It's very safe. There are some things you need to be a little bit mindful of with currency hedging. If I was operating an ETF that I just described, and I recognized a profit or in fact a loss on the currency hedging, I would need to sell some of my underlying shares to fund that loss. And what this means is it's easy to do that with exchange traded funds because the underlying portfolio is liquid. However, if you are investing in a private asset fund where the underlying assets held by the fund are not liquid, then that can introduce a lot of complexity and can be problematic. So where you have a fund that is in using currency hedging, it is important that they have some way of, essentially a liquid portfolio that they can fund that currency hedging activity. So that's one thing to think about. The only other thing I think is really worth knowing is that, we sometimes get this question. People will look on Google at the NASDAQ index in the United States, and they'll say that over the last month or maybe over the last year, the NASDAQ index is up, let's just say 20%. And they know that index is in US dollar terms. And they'll look at a currency hedged fund, such as our HNDQ, which is our currency hedged NASDAQ fund. And their expectation is that fund will necessarily match the performance of the US index. Now, there are a couple of reasons why that is not necessarily going to be the case. One is that the fund itself does have a management fee applicable to it. So you'll see that. But the other reason, which can create differences between a currency hedge fund and the performance of that index in US dollars, is that currency hedging has either a cost or a benefit, which, without going too far into the weeds, is based on the interest rate differentials between the US and Australia. And so that can see slight deviations between the US dollar performance of the underlying index and the Australian dollar performance of a currency hedge fund. Now, those interest differentials are coming down with the US dollar interest rates being cut, but that can result in some minor deviations. Overall, though, you would say that currency hedging is a very effective way of mitigating that currency risk.
So, and I think that's a good summary, because I think for a lot of people that listen to this, they're more interested in ETFs than, say, like some of the other things which you mentioned, like real assets or like private assets. And I think that if you're investing in a currency-hedged ETF from here in Australia, like you said, HNDQ, there's another one that I'm going to bring up in a moment. These types of ETFs are very well regulated, very sound, and you can invest with them in them with absolute confidence. The final question that I have on this before we get to this example, which we're going to use the Gold Bullion ETF as the example, is another question that we always get on our investors podcast, Cameron, which is, okay, so I'm picking up what you're putting down. I can use one of these currency hedged ETFs. And if I was going to invest in NDQ, well, maybe I could invest in HNDQ or invest a little bit in both or whatever. But the question that people often get is, and I get this a lot, and I don't always have the best answer for this, is, well, how much, how do I know when I should use a currency hedge one over a normal one, if that makes sense?
Yeah, it's a great question, and we get the question a lot ourselves. We would break that decision down as to how much currency hedging that you want to use into really twofold. The first is thinking about long-term risk and return outcomes in what we would describe as a strategic asset allocation. So, for example, what I mean by that is, if I have no particular view as to whether or not I think the Australian dollar will appreciate or not, then what do I think is the right amount of currency hedging to hold within my global assets? And I'll cover different asset classes. For defensive asset classes, such as global bonds, our view is that you should be, in all likelihood, 100% currency hedged for defensive assets, because currencies can be volatile. And for defensive asset classes, you really want, if you like, whether it's interest rates or whatever it is that's driving your returns, to deliver, to essentially provide returns and define the risk profile. If you use a global bonds exposure which doesn't have currency hedging, then the currency could really change the way that exposure behaves in your portfolio. So, thinking about that the defensive allocation, like, global bonds, always 100% currency hedged in my view. For global equities, it's more interesting. Now, what we, sort of look at when we're sort of thinking as to whether or not you should be currency hedged from a strategic perspective is thinking about that sort of risk-return trade-off. In very short-term periods of market volatility, the Australian dollar can behave as what we call a risk-on currency. In other words, being unhedged over a period like the COVID sell-off meant that your US and global assets held their value more than if you had used currency hedging. So in a very short-term view, in a market sell-off, it can be helpful to be unhedged. The other side of that coin, though, is longer-term trends. And I talked about that example of the US equity market having a very, relatively strong performance over about an 8-year period in the early 2000s. But if I hadn't used any currency hedging, I would have been very negative in terms of my return. And so our view from a strategic perspective is it probably makes sense to have a allocation to currency hedged with global equities, but not have your entire portfolio currency hedged. And this is not advice or recommendation of a strategy, but our view within our investment committee was that within the accounts that we manage, was around about 30% of our global equities should be currency hedged. So this is a very long answer, but that's a strategic decision. Your other decision as whether or not you want to take a view on currency, which can be difficult to do. But we have seen in this interest rate cutting cycle in the US, where their interest rates have been much higher than Australia and are coming down, we have seen the Australian dollar strengthen against the US. So if you want to express a dynamic or a tactical view, then in other words, you think the Australian dollar, which is testing 70 US cents, is going to breach that level, then you could profit from, if you like, from using a currency hedged allocation. So yeah, remembering that US dollar assets are the majority of our global equity exposure, a view on the Australian dollar appreciating, that sort of active decision can lead you to deciding to have a tilt or a higher allocation to currency hedged. And as a case in point, within our IC, we have a slightly higher allocation to hedged global equities because our current view is that the US is going to be cutting more quickly than the RBA. And so therefore we think that there are tailwinds for the Australian dollar, which mean that having a slightly higher than standard allocation to global equities, so slightly higher currency hedging is a benefit for the portfolio. And over the last month, it's certainly turned out to be the case.
Yeah, that's a good point. So just to double click on the first point you made, which was for defensive assets, like say bonds, government bonds, if you're investing in global government bonds, if the return that someone listening to this would expect from that is 3, 4, 5% per annum, a currency can move that much pretty quickly. So it's almost always, well, in like what you said, I agree that it's almost always the approach that you want to be currency hedged in that regard. And I'm actually really interested. I was really interested to hear your take on how you would protect a portfolio, because a lot of us would agree with you, Cameron, that over the long term, we think that like a lot of those global markets, like the United States in particular, has so many great companies, and we can see some really clear skies ahead in terms of those businesses doing better and better.
Yeah.
But if the currency kind of wipes us out on the way through, we want to protect our portfolios. So that makes a lot of sense. So I've got one final question on the currency hedging before we move into some of the listener Q&A.
Sure.
And this was around one of your really popular ETFs, which is the Betashares Gold Bullion ETF, Currency-hedged, which is the ticker symbol it trades under is QAU. When I checked the monthly or the website recently, it said $710 million was invested. So that's the funds under management. Can you just explain this ETF and the value of the currency hedging, say if the Australian dollar continues to rise? Because this is, I got to be honest with you, mate. Like, this is something that I'm thinking about. Like, is this now, like, no recommendations or anything on this show for full, disclaimers, but this is something that I'm thinking about right now. Like, gold has performed really well. But if the Australian dollar continues to rise, maybe I need a currency hedged option.
Yeah, that's right. And that's ultimately, I guess the point is when we look at the price of gold in the media, it's always quoted in US dollars, isn't it? And that's really, the measure of the value of gold is the US dollar price of gold, not the Australian dollar price of gold. Look, I mean, there are a number of, gold bullion ETFs available on the ASX. This is, so QAU, which is our fund, is actually the only currency-hedged gold bullion ETF, which is actually sort of almost astounding because, when you look at the relationship between gold and what drives gold, there can be different drivers, but, two of the key drivers are interest rates and the opportunity cost of holding gold, because gold is not a yielding asset. When yields, in particular, real yields are falling, it tends to be a strong tailwind for gold. But also another strong tailwind for gold is when the US dollar is depreciating, because people will use gold as an alternate store of value when the US dollar is coming under pressure. And so what that typically means is that if the US dollar, is depreciating, our Australian dollar as a flip side will be appreciating. And so what you can see if you don't have a currency hedge gold exposure is that the appreciation in the gold price in US dollar terms is not really translating through to your unhedged gold exposure. So QAU solves that problem because it has gold bullion, but it also has currency hedging. A good example of this would be if you look subsequent to COVID from the end of March through to, I think it was around about sort of, August, the US dollar depreciated pretty substantially and the gold price touched new highs at the time. It was up from about $1,400 an ounce US dollars to around about $2,000 US dollars an ounce. So about a 30% appreciation over that time period. But if you held that without currency hedging, you were basically flat. And so, taking currency hedging as part of your gold exposure, I think makes a lot of sense given what some of those underlying drivers of gold prices are. So yeah, with falling Fed funds rate and with the chance of the US dollar depreciating off the back of that, it would certainly make sense to consider a currency hedge gold exposure right now.
Yeah, and that's why I wanted to use this as an example. And that's such a good illustration of the point once again, which is that while it might seem like we're talking about really technical things, you can do all of the wonderful research and think, I'm going to buy some gold, I'm going to invest in it via this ETF. But then it comes down to that split-second decision. Do I go with the hedged one or the unhedged one? And that then defines basically everything about the investment. And we've never really talked about this at any depth, so I'm glad we got this opportunity. Now, we do have some questions that were sent in, and they're quite they're good questions, actually. And they're kind of pretty straightforward, but I'm keen to get your take on them. So I should just start out by saying that obviously anything that we do mention here, Cameron, you know this, you know the drill, there's the disclaimer at the beginning of the show, and there's another one here.
Yep.
Yeah, it's general information only. Please read the product disclosure statements of any of the ETFs or funds that we talk about. They are available on the ETF provider's website, in this case, Betashares, and speak to your financial advisor who can take into account your needs, goals, or objectives before acting on any of the information you hear in any of our podcasts. So the first question comes in from Clean Future Leader. They ask, I would like to invest in an ethical fund with a future clean energy ETF that will be sustainable. Would you know any good ETFs for the above? So what we're suggesting is just some things for them to go and research, Cameron.
Sure. So, we have a range of what I would describe as ethical and also sustainably themed ETFs in our suite. Our core ethical fund in terms of global equities is EFI, Global Sustainability Leaders. It's not specifically designed to be a clean energy ETF. It is a broad-based global equity exposure. It does have a positive screen or positive inclusion of companies that are clean energy companies. Another fund in our suite, which is ethical, or in fact, even I describe as more stringent, an impact fund is Earth, which is our climate change innovation ETF. And this does have a pretty substantial allocation to companies in clean energy, whether you're talking about sort of First Solar in solar or say Vestas in wind turbines, these sorts of companies that are very important in terms of decarbonisation, but it also has a range of other decarbonisation, solution providers. I guess when we sort of talk a bit about, the clean energy transition, it's not just about having zero carbon energy, it's also about reducing the use of energy and improving energy efficiency. So Earth can be a really good one for a well-rounded solution. And then more specifically, we've got TANN, TANN, which is Betashares solar ETF, which holds companies involved in the supply chain of solar energy equipment and manufacturing.
So we've got ETHI, ETHI.
Yep.
Earth, which is ERTH, and TANN, TANN. ETHI's got to be one of the biggest ethical or that like sustainable style ETFs, surely.
Yeah, I absolutely believe it is the biggest. Off the top of my head, it's one of our biggest funds, and it's been very broadly adopted because it is very stringently screened, but it's also actually been very well balanced in terms of its. A lot of people think that an ESG fund will be quite skewed to growth companies, and ETHI has been very robust throughout all parts of the market cycle, and it's why it's a really good core allocation within portfolios, and it's performed extremely well. So we're very fortunate in terms of the support for that fund.
Yeah, it's been very, very popular with the Rask community for sure. Gracie writes in and asks, how much of the stock market, this is a really interesting question actually, how much of the stock market is now invested and traded with ETFs? And does this create big risks for investors? You and I, I'm pretty sure, have tackled this once before, many moons ago.
Yeah.
Such as what happened during the GFC. So they're basically asking, is there a risk that so many people have invested in ETFs that itself becomes a risk?
Yep. Yeah, I think the question back then you were asking me about some of Michael Burry's comments. Yeah, the guy who loves to call bubbles, but sometimes gets them right, actually. So, this question does come up a lot, and, ETFs and passive investing has become very popular. And, perhaps, there are some people who with a vested interest in fear-mongering about this. To give you some hard stats in terms of if we look at the impact of ETFs on a market, it's important not to look at the size of ETFs because we know that ETFs will cover multiple asset classes, but really think about how do ETFs impact a specific market. And, the market that, for the last sort of year that people have been saying has been impacted by equity or ETF flows is the US equity market. People have sort of said that NVIDIA's share price is the result of passive money and alike. Now, to give some hard stats there, if you look at the US equity market and you look at the ownership of the US equity market, what proportion do ETFs make up of that overall market? It's around about 8% of the total US equity market is owned by ETFs. If you add in passive mutual funds, that's another 6%. So it's about 14% both ETFs, and ETFs in the US are also actively managed ETFs. 14% being ETFs plus passive mutual funds. A much larger segment of the market and an area that's been growing in terms of total ownership of the US equity market is in fact household investors. They now control about 40% of the US equity market. So there certainly will be a point where ETFs own too much of the market and passive owns too much of the market, where markets become inefficient and this fear-mongering actually has legs. But I'd suggest we're nowhere near that point now. What that point is, I couldn't tell you, but don't forget that ETFs are also a very good source of liquidity in market crisis. And we've actually seen that during periods, whether it be the COVID crash or other periods of market instability, ETFs have actually added liquidity to the system. And in fact, those sorts of episodes really do help prove out the validity of these investment vehicles and their ability to create great outcomes for all investors.
Yeah, the ETFs have been going for decades. It's not necessarily something that's like a fad that's just come out of nowhere, right? It's really interesting that you throw those numbers at us. Yeah, I remember it was the Michael Burry comments.
Right, yeah.
Yeah. The broken clock may be right twice a day, as they say. Best of luck asked a question. And this was more about how often do ETFs pay their distributions, which is, I'm building a portfolio for our retirement out of ETFs. To do that, I'm following the 3-bucket strategy: short-term, medium, long-term income. My general question is, why do some ETFs pay income monthly, some quarterly, half-yearly, or yearly? Is that a choice by the ETF provider? For example, the Betashares AAA Cash ETF pays monthly income.
Yeah, so I mean, just to talk specifically about the AAA Cash ETF, it holds cash in bank accounts, and it's really designed to be a substitute for a bank account. Hence, it pays monthly. I'll talk a bit about our Betashares funds, because I shouldn't speak too much about other ETF providers. But if you look across our fixed income and cash ETFs, like, we recognize that people invest in these funds because they want income. And so all of those funds, all the Australian fixed income funds, are designed to provide monthly income. They'll pay monthly distributions. We think that's an important characteristic of that asset class, that people want that income. We also have, within our equities funds, we have a range of funds which pay quarterly distributions for those who are perhaps, those funds that are more income oriented. That includes, say, YMAX, which is a equity income fund, like QAUs, which is a fundamental fund but has a very high level of income, and also A200, for example, which is a Australian broad equity market exposure. For those funds, they're providing pretty substantial income, and so paying quarterly distributions makes sense. Within our global funds, aside from some funds that are income orientated, we tend to pay semi-annually. The level of dividend income you can receive from global equities tends to be a bit lower than what you receive in Australia. So, it doesn't necessarily make a hell of a lot of sense to have quarterly distributions for a global exposure with a low level of income. But, where we can, for income-oriented investors, they're going to use products that, really one of the reasons you hold them is to receive income. We want to make sure that frequency of income matches their expectations. And I think we're quite mindful of the importance of income for investors when we're building products.
I actually, the first thing that I added, I run this the Thursday live show, Cameron, and we've got this fake $1 million portfolio that we track, and the first fund that I put in was AAA, just because I knew that every month this fake $1 million would keep earning interest, which we could then keep investing in over time into the market. So our final question from a listener goes by the name of Core Strength, asked a question about the core portfolio of ETFs. They say, which asset classes are a must-have? And I think we were talking about this off air. I think it's more along the lines of, like, which ones go in first.
Yeah, okay. So it does depend, like, as we just said before, this is all general information. It probably depends a little bit on your own personal circumstances and your risk profile. If you are, for example, someone who can, bear a portfolio which is entirely made up of equities, we would generally suggest that equities are going to have a higher expected return over the long run, but they'll have a higher level of risk or volatility. So typically the thing that you're adding first is equities, and that might be global equities and Australian equities. And they are going to give you the highest expected return, but obviously you have to be comfortable with the level of risk. And for some people, they might be entirely comfortable with a portfolio made entirely out of equities. If you are, however, not able to stomach that level of volatility and the risk of drawdown in a purely equities portfolio, that's when you start to think about adding in defensive asset classes, so a third asset class. And it does depend a little bit on your objectives, what is within your equities portfolio. But, options within defensive assets will often include cash. So we talked about AAA or fixed income and bonds. There are a range of other fixed income ETFs that you can choose to add. Always important to think about how they blend in with your equity allocation. But for a lot of people where most people will have the majority of their portfolio in equities, I think of that defensive allocation as not necessarily something where you're trying to get the absolute highest level of return. I'm also thinking of what it's doing in terms of diversification, and is it, for example, providing an offset to my equities in market turbulence? Is it appreciating ideally when equities are selling off? And so the rationale and what you're looking to get out of defensive assets can be different from what you're seeking out of your growth assets, which predominantly is strong returns.
Yeah, we get a lot of younger people like, why don't I just have 100% shares? or 100% equities, right? But my question is, well, one, is that suitable for you and your risk profile, like realistically? And two, even if you have some of those bonds and some cash, you might be able to reinvest that at better prices in the future while also helping you sleep at night. So a lot of people, I often say that a lot of people are high growth investors until the next market crash. And
true. That's true. You really find out, isn't it? Yeah.
Yeah, that's it. So keep your wits about you. Now, we've mentioned a lot of different funds. I'll put a link to the Betashares website, particularly around some of those hedged style things that we talked about, like I'll put a link in for the QAU ETF so people can explore that, but also your article, I think that will be at the top of the list. It's really important, as well as some of these other ETFs that we've mentioned. Now, I'm going to insert one final disclaimer, and this last one's more like a kind of, I don't know, bit of fun, let's say. And it's not a recommendation. I'm just curious. I asked Tom, your colleague, a similar type of question not too long ago on the show. So I'm going to ask you, and I'll ask it in a very deliberate way, Cam. I'll say, if you had to make one small satellite investment in any Betashares ETF today, and then look away for 10 years, which ETF would you pick and why? Now, there's no recommendation. I'm just curious, like, there are so many Betashares ETFs.
Yeah.
So there's the favorite.
What did Tom say?
Well, I asked him, this was different. I asked him about which asset classes. So he didn't select an ETF or anything like that, where I've got the big guy on the show, so I thought I'd ask you which ETF.
So I've probably got two answers. One is not my favorite, but if it's a small satellite allocation, I mean, I did talk a bit about asymmetric payoffs. Crypt, which is a very volatile exposure. Look, I'm not a crypto bull or by any means, and I think there's probably potentially a greater chance of implosion of that market than success. But, there is clearly the potential for asymmetric upside. And so if you're only allocating a very small amount of your portfolio to something, under the school of thought of Nassim Taleb, which is one of the books I mentioned earlier, you can afford to take, a fair amount of risk there and then have that, potentially material outperformance. That's, one way to think about asymmetry and how you can incorporate these sort of payoffs into your portfolio by using only a very small amount of your capital that you can afford to lose. But within the sort of the norm of satellite allocations, within our suite, HACK, a global cybersecurity ETF, that industry is one that just has really strong tailwinds, really actually quite defensive as well in terms of an industry. We know that cybersecurity is the last area companies cut in terms of their IT spending. And there's a lot of M&A activity. We constantly see rising companies getting bought up. So I think on a 10-year time frame for a satellite, that's a really interesting place to invest. Cybersecurity.
Love it. Those are two really interesting answers. I didn't expect you to say Crib is a very, very small potential one. But I do love that idea of asymmetry. A lot of people don't think about that also in their life is, there's risk attached to all of the good things, it seems. Like whether it's getting in a relationship and risking that, and your emotions with someone, or whether it's putting your money on the line or starting a business, they all involve different levels of risk. And position sizing is really interesting the way you frame that. So we've got Crip and we've got Hack, both really interesting reading, particularly with the whole CrowdStrike thing not too long ago. We had someone write in about that and said, hey, I invested in CrowdStrike and I'm not, covering myself in glory. But mate, this has been heaps of fun.
Thanks, Cameron. That's good, yeah.
I really appreciate you taking the time to join us.
Always great chatting with you. Thanks for having us.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.